everyone, and welcome to IIE Financial's educational series, The Line in the Sand. The purpose of this session, will be here probably about 10 minutes or so, is really to talk about what is your line in the sand when it comes to losing money in the financial markets. You know, I really, when I think about losing money in the financial markets, especially in our retirement accounts, it's important to realize that, you know, there was a really good book written about 2,000 years ago that says a wise man leaves an inheritance to his children's children. And my mentor pounded that into my head, and it's something I've always believed. And when you go back and you think about Warren Buffett, I mean, he's fairly smart. He says a lot of good things. And, you know, it says rule number 1, never lose money. Rule number 2, don't forget rule number 1. And in our investment portfolio, I don't know if we always think that way. Right? In our investment portfolio, we tend to think about traditional advisory practices, and the first one being buy and hold. And oftentimes I like to call that buy and hope, because we buy something and we hold on to it forever. We hope it's going to go up. And then when it goes down, we are told to just buy more, and we can dollar cost average on the way down. And that might be okay in certain indices, and based on your age, maybe that's all right. But as you get a little bit older, it might not be a great idea to hold on for a 30, 40, 50% correction. Well, the other thing is what we're told to not try to time the market. And if we don't time the market, then what we have is we've got this issue where we buy something, we hold on to it, and our account will go up and down without any control of our own. So when you think about your own retirement plan, which philosophy does it follow? Does it follow never lose money, or does it follow buy and hold with dollar cost average and don't try to time the market? See, because they're two very different things. So what I'm going to do is, you know, over the course of the next little bit, we're going to talk about what are some things we can do to protect ourselves in times of market downturns. And especially when we think about retirement accounts, the way most people, I say most people, the way many people invest in their retirement accounts and their retirement portfolios, they use their 401k. So there was a really great article at Kiplinger that talked about the top 105 funds in the 401k retirement savings. Now, these are mutual funds. Traditionally, mutual funds are the investment of choice for 401k holders. And those mutual funds, as we go through, I highlighted all of them, which are stock funds. I left out the bond funds, but theoretically, a bond fund will be, will still be a fund. It'll still perform in a very similar fashion, but these are our most widely held stock funds, according to this article at Kiplinger. And these are funds that people have heard of, right? A Vanguard Institutional Index Fund, a Vanguard Wellington Investor, the Dodge and Cox Stock Fund, the Fidelity Growth Fund. These are all very big, very much held funds. Now, what we're going to do is take a look at these funds and look at them from a perspective of reading a chart. Now, a chart shows me the history of what has already occurred. And I'm going to pull up a chart of each one of these funds. Now, take a look at this chart. And it may be difficult to read all of this, but the one I want to really highlight the most would be the S&P 500. Now, the S&P 500 is up in the upper left-hand corner. And the S&P 500 is the one that represents the whole stock market in general. Well, if you take notice, these are our different funds. We've got the same symbols here, VINIX, FCNTX, AEPGX. Those are the same symbols as what we just talked about in the prior slide. And when I look at the chart here, what do we notice about all these funds? Well, the first thing we should notice is that they all basically look the same. They all basically have the same shape to them. And so that allows me to really just use the S&P as a proxy for the market in general. And that's what we're going to do. We're going to use the S&P as a proxy for the market in general. So essentially, the S&P 500, because it is the largest and most important index for the U.S. equity market, it's the one that we're going to use to make our investment decisions, to know where to place our line in the sand where we don't want to lose any money. And the S&P is a really good, broad, diverse companies that can let us do that. So here's a picture of the S&P 500. Now look at this. We're going all the way back to 1981. And if you're a buy and hold investor, it's really easy for people to say, wow, a buy and hold investor, they bought down here and they held it up here and they've made a ton of money. Well, for the most part, I think that it would be a fallacy, right? And I think many people when you think about it, there's the perception of what happens in the world, and then there's the reality. And as the markets are going up, how are people feeling? Well, they feel amazing, right? Things are good. It's a new normal economy. And then we get this little move down. Now, this little move down, as we say, was really the dot-com bubble that burst in the American stock market. Now, we're looking at the S&P 500. If we looked at the NASDAQ, it would have been a much deeper decline during the dot-com bubble. But the S&P 500, which is a major market index, it took about a 50% correction. And that 50% correction for those people that had money in their 401ks, as it's continuing to drop, many of those investors, down here at the bottom said, you know what, I'm out. I'm going to get out. I need to just bail. I can't stay in this thing any longer. And then as it started to go back up, do you think most of those investors were able to time this bottom? Probably not. And maybe they get back in somewhere up here. Well, here is the credit bubble crash. And I think it was about 56% that the S&P dropped this time around. And so we had these huge 50% corrections. Now, when the market drops 50%, it takes 100% return just to get back to break even. Think about that for a minute. If you have a $200,000 account and you lose 50%, you now have a $100,000 account. If you have a 50% gain, your $100,000 account grows to $150,000. So you're not back to break even. So once you get a 50% correction, it takes 100% improvement to get back to your break-even number. And then we had that secondary fall again. Now, the markets from 2009 have continued to rally, and we are at an all-time high at the time that we did this recording. And so where is really, what is there to worry about? Well, I want you to put yourself in the shoes of somebody who's in their 50s or in their 60s. And you're listening to this at home, might be in your 50s or in your 60s or in your 70s. And when the market dropped like this, and it dropped from 2000 to 2008, and it got back to break even in 2013. So that was 6 years of lost time. If you held on through the entire move down and the entire rally back up. Now, if you continued to buy the whole way down, you were buying more shares at a lower cost basis. But I think that there were many, many people that had a knot in their stomach, a pit in their stomach, if you will, where they no longer really wanted to be buying as the market was screaming straight down. Wouldn't it have felt better if they would have gotten out somewhere here at the top? Well, why does this happen? Right? Why does this exist? And there's a really good picture of a traditional market bubble. Now, what you're looking at is a traditional market bubble, and this market bubble, the concept is that it will vary very far away from the mean, right? We will grow way above the mean in price, and this being the mean in price. And when the market starts to go off, there's a takeoff, and then there's a first little sell-off. They call that the bear trap because a lot of bearish investors jump in, and then all of a sudden the market starts to go up, and now you start hearing media attention and enthusiasm, and all of a sudden we see greed and delusion. Now, notice here, the smart money gets in during this stealth phase while the markets are still pretty low. And then the institutional investors, and here's when the public gets involved. The public gets involved when it becomes greed and delusion and a new paradigm. We're in a new normal economy. You hear that all the time. It's a new normal economy. Things are different today. And then we get this strong move down where people have this period of denial. And denial is not just a river, but I'm bum ching. It is what people feel when they are so excited that the market's worth this all-time high, and then it fell down. Now, then there's that slight return to normal, which makes people feel better before fear, capitulation, and despair set in. Now, capitulation is known, by a lot of professionals in the industry, and pardon me for being a bit graphic, but a lot of them will call it the puke point. They'll call it the point where the novice investors, the retail investors, will puke up their stock. They've just had enough. They just want to get rid of what's making them sick and slow to move. And so they get rid of it. And when they get rid of it, it goes down even faster. But who's there to buy it? Who's there to buy it? If we think about the financial marketplace, there's two distinct groups. There are the retail investors that are working hard every day, putting money in their 401ks, their IRAs, their whatever they're doing they can. And then there's the Wall Street investors, the professionals. And so when they're down here and the novice investors are selling, Wall Street wants to step in and buy. and then we get a return back to the mean, and this happens all over again. So what does that mean for the S&P? Well, interestingly enough, so take a look at the shape which we just spoke about, and let's look at that at the S&P. Well, look what happens if we just overlay that picture. It's not exactly perfect, but pretty close. Well, what if we overlay it again? Wow. See how how well that just kind of overlays when we lay it over the S&P 500. So the question is, where are we now? Where do we feel like we are now? Now, I'm not saying that we're going to have another 35% correction or a 50% correction or a 60% correction, but what I am saying is, what happens if we do? And where is your line in the sand as an investor to tell you it's time to get out of the marketplace? So what we want to do is figure out where's the point where we say, that's it, enough is enough, and we're going to get out so that we don't lose too much. So the biggest question is, when does the market go down? Because when we look at this market as it's been rallying higher, there were people that called the top here, and people that called the top here, and definitely people that called the top here, and people that called the top here, and they're calling the top again. But how high can that market go? Well, that market can go as high as it wants to, right? How high can a tree grow? Well, if you keep cutting the tree down, you're never going to know how high it goes. So what we're going to do is we're going to look for what's called line in the sand, the area where buying and selling have a relatively even basis point. So we're going to go back and do a little time travel here and talk about the line in the sand. Now, what we look for when we identify our line in the sand, and we talk to the investors at IIE Financial about where do we place our protection. And so what we look for are areas where buying and selling are relatively even, because the market really exists to facilitate trade, right? That's what it exists to do. It exists to facilitate trade. And when we see that area where supply and demand are relatively equal and buyers and sellers are relatively even, then we know that that's a fair value area. The price is fair. Well, the market feels like that's a good price. And that's really where, if we're in the market, we should place our line in the sand, just below those areas. And then as the market starts to go up and creates new areas, we will move our line in the sand. In this case, we moved it up just a little bit. And then as the market continues to go up, we continue to move our line in the sand until eventually we may move our line in the sand. We continue to move our line in the sand, and then we're out of the market when our line in the sand gets crossed. So we're out of the market. And there's no reason to take this big hit off of the dot-com bubble burst when we're out of the market for this. Now, when do we get back in? Well, we get back in when we see two consecutive higher areas of consolidation, two consecutive higher areas where we believe that there are buyers and sellers at a state of equilibrium. So it's really two consecutive higher swing lows. And once we get this second one, we're now back into the market and we've got our line in the sand. Now notice when we do this, are we getting the absolute top of the market? Absolutely not. We're getting out right as it comes down. Are we getting the absolute bottom of the market? Absolutely not. We're getting in after it's come up a little bit. But are we doing a really nice job of avoiding these catastrophic declines? And that's what keeps us, in a good position. Now, it doesn't mean that we're completely not investing during this down period, because remember, as the U.S. stock market goes down, there will be other things that do indeed go up in value. And maybe in that time, in that period, it's time to look at things like bonds or currencies or gold or whatever it might be, and we can still utilize the same strategies in those investments as well. So as the market continues to rally up, we start to see these areas where relatively even buying and selling exist, and we notice we just continue to move our line in the sand up, continue to move it up until all of a sudden we finally are out of the market. Now we're talking about 2007. So what this does is this gets the investor out before the market comes crashing down. And now, once we get a little bit of basing before a rally up, we get two of those in a row, and we have now a reason to get back in the market and to place our line in the sand. Now, as the market continues to rally higher, we continue to move our line in the sand. And if you've noticed, from 2009 to today, we are continuing to look at the line in the sand and where indeed it gets moved. Now, we come to this point. This is actually a really interesting one right in through here, where we had, and I actually forgot to draw a little line right around this area here. We'd move our line in the sand to right under this range here, and it looks like I left one of those movements out, but we move our line to right under this area in here, and then neither of these are new areas of consolidation, which create new bottoms. So this would be an area where if you were too aggressive, you could have gotten shaken out. But you'd be back in right at this level anyway, and this is where the line in the sand would be. And then price continues to move up. Interestingly enough, our most recent line in the sand right here was tested on election night when the U.S. presidential election occurred, allowing us to continue to move that up. And here is the current line in the sand. This is where our current line in the sand is sitting in the S&P, relative right around 2,300 in the S&P is our current line in the sand. So that means this is the area where if the market does go down, we start to wonder about how far down will it go. At II Financial, one of the things that we do is all of our investors, every investor that we have, the first thing we talk about is what is their comfort level with risk? What is their tolerance to loss? And are they okay with having a line in the sand? Because we firmly believe that you have to have a line in the sand if you want to protect yourself and protect your life savings in market turmoil. If you want to learn a little bit more about this or you've got some questions, feel free to give our offices a call, 832-953-4998. Visit our website, iiefinancial.com, where we've got a few more articles. If you like what you heard, do me a favor, subscribe to the channel, and you'll get updates whenever we put new educational material out there. Thank you so much, and everybody have an amazing, amazing day.